Now, I love Phoenix, Arizona. I'm heavily invested personally in Phoenix, Arizona. We have the Taiwan Semiconductor plant. It's a $160 billion, not million, billion-dollar plant. You just got a $100 billion order from Nvidia to make the AI chips. They're partnering with Intel. Wall Street Journal just did a documentary on how amazing our truck route 303 is. There's just construction literally everywhere, and we're a manufacturing town. Tremendous growth potential. And I think, I've been in business for a really, really long time, 50 years. I think this is the best real estate market I've ever seen. Probably going to be the best in the world, but we're ahead of ourselves. I think foreclosures are coming to Phoenix, Arizona. Now, the reason I got into this was I watch other producers that people are doing the same thing I am. They talked about Phoenix, and they talked about someone who was saying Phoenix homes were dropping in value, and that this was clickbait. Well, I happen to be here. We have a huge portfolio that I represent, and we monitor this regularly. And yes, the affordable homes here in Phoenix, Arizona are definitely dropping in value. We're going to talk about that. I'm going to try and not make this too terribly long a video. But you have to remember that Maricopa County, Phoenix, Maricopa County is one of the largest counties in all of the United States. It's larger than Vermont. It's larger than New Hampshire and Connecticut put together. This is an enormous geographical piece of land. And of course, it's got all kinds of markets and submarkets. Now, when we start talking about the affordable homes, which is what I'm into, these guys are in trouble because they are very interest rate sensitive, and they don't put much money down. They're starters for the most part. They're affordable homes, and they get in for, most of this is probably 60-70% of these properties are FHA, 3.8% down payment. And of course, then they have to pay mortgage insurance premium, MIP, on top of it, and they always finance that. And that's about 3%. So if you put 3% down and you finance 3.8% or 3.8% down, you finance 3%, there's not much equity there. So they're basically in there. Yes, they did have a down payment, but it's almost all gone. And if we have any kind of hiccup, well, there's no equity in the property. And of course, this is the same thing. Most of these starters are, if they're not FHA, maybe they went VA, no money down. 3% down with conventional, we have 5% down. So almost all of these affordable homes that are recently purchased are really low down, 5% down. Now, these guys are in trouble because obviously interest rates are very, very sensitive to them. And you can rent a house here for $1,900, or you can buy it and make it your own for $3,300. So you can see the disconnect here when you start talking about affordable homes. Now, Scottsdale is also in Maricopa County. They are not in trouble. Scottsdale is beautiful. I live in Scottsdale. I live in a gated community with a country club and a golf course, and homes are selling very, very well there. So we have a roving guard. We're right at the base of the mountains. It is just stunningly beautiful. Man, a house comes up on the market, it sells right away. Now, I'm going to tell you, you can buy say a 4,500, 5,000 square foot home. That's granite countertops, beautifully taken care of, just immaculate, on a golf course here in Arizona for, $2.5-3 million. It's a lot of money. But if you just came out of Palisades in California and you've got an 1,800 square foot home that you just got an insurance check for $3 million, you come here to Scottsdale. These 5,000 square foot homes look pretty doggone nice, and they're selling like hotcakes, particularly when you have all these people leaving California to get away because California is such a mess. It's such a problem. So submarket, that market's not doing bad at all, but other markets here in Maricopa certainly are. So let's just talk about a couple of the sub markets because they are certainly in trouble. Let me go to my first slide and let's just talk about it because foreclosures are coming here. And let me just go over as to why I think that's happening. And we can certainly talk about that. Now, it's unavoidable coming here to Phoenix, Arizona. Just absolutely, totally unavoidable. Let me go to my first slide and we can just change this. Now, we've been talking about my timing model. Well, my timing model got triggered. Now, when you're dealing with these timing models, what the timing model will do for you is it tells us what we should expect. It tells us a time continuum. It tells us what the next event is going to be along the time continuum, and we start looking for that. Now, I've been waiting for a very significant one where one of my next significant markers is going to be the waterfall, where things just collapse and start falling down. Now, I listen to everybody else just like you guys. I listen to John Hussman. He sends out his newsletter, and in his newsletter, let me see if I can open this up a little bit. He's talking about the fact that his data is showing that in the next few weeks that there's a trap door possible in the stock market. So he thinks it is fully valued. Now, he's been saying that for the last year or so. We're actually higher than we were in the 1929 stock market. And we're so fully valued, he is saying that there's a possibility that we could have a fast, what he calls it a trapdoor, I call it a waterfall event, where stocks just decline rapidly. Now, I've been waiting for that to happen. But one other thing, the main thing that I saw, and I saw that, and that was just a week or two ago, you saw that where we just had this enormous, 1,000-point drops. What a lot of people did not see was the fact that credit started wavering a lot. And people saying, well, the interest rates are going down as the stock market is going down, and the U.S. dollar is going down too. People are trying to sell the dollar and get out of it. They're going to rechange the currency. I don't think so. People are selling the assets that they have, and they have, all the banks across the world hold their reserves in what? U.S. Treasuries. And when they start running out of dollars, they sell U.S. Treasuries. And we've had really great problems around the country, around the globe, really, the country and the globe, more so in Europe and like in Japan and Korea. These places are really having problems, and they have great need for U.S. dollars. So how do they get U.S. dollars? They sell U.S. Treasuries. When you sell the U.S. Treasury, what happens? Interest rates go up. This happened, if you look at the Federal Reserve Electronic Data System, you can see this is exactly what happened in 2008. It is exactly what happened in 2008. People sold the U.S. Treasury bonds, got dollars. And I say, well, the dollar's going down. Well, of course, dollars don't do you any good if you're in France. You need to have, francs or Swiss francs or German Deutschmarks or, yen or yuan. So they have to sell the U.S. dollar to get those. So not only do they sell the U.S. Treasury bonds, but they sell the dollar as well because they need to convert it into usable currency. And I saw that. So that triggered my model. So I know that in my work, that makes us very close to having a culmination. Remember the cycle in my business and in my work shows that the cycle is ending, and it's going to end brutally. So that's what's happening, and it's a signpost that it came along exactly when we were looking for it. It's just confirming that we're there. Let me go to my next slide here, and we can take a look at this. So now look at this is a culmination of the fact that liquidity peaked April of 2022. This is a very, very important date. It peaked. We were just putting in, just trillions and trillions and trillions of dollars. We peaked here, and then they started taking it out. Now the draining began. Liquidity peaks, and then they start taking money out. Now, I'm going to tell you, what do you suppose drives the economy? It's not love. Trump's not doing it. It's liquidity. If you don't have liquidity, nothing moves. And the Federal Reserve has been removing all this liquidity for the last 3 or 4 years. And, it takes a long time. This is not something that happens overnight. It takes a long time, and it's coming out. And we're getting to the point where we're draining the system. We're actually negative. First time that's ever happened. First time ever that we actually have a negative liquidity. They're taking more liquidity out. And you can see that if you do my other videos. And by the way, if you like my videos, give me a thumbs up and subscribe. Oh my gosh, does that help us with YouTube? We're not going to send you anything. It's nice to know if you like our videos that we're being appreciated. Also, I love your comments to see what's going on in your marketplace. Now I'm going to tell you, we start talking about liquidity. It's a problem because it's leaving. Let me go to my next slide, and let's just talk about that. Now, you can see that. And here's one of the reasons is just like in the great financial crisis is the same thing that's happening. I got this from John Rubino just a couple of weeks ago, and it's from Wall Street. So you can see the fact that you get this financial crisis just like this is the same thing that's going on. We've talked about this before. You know, the commercial is ahead of housing, and this is what they're looking at. This is going up, and this is just this left side of the axis. And when it starts coming down, just like here, it comes down and you start taking tremendous losses. And those losses end up being problems with liquidity. And the banks need to sell their reserves to pay for the losses that they're taking. And if you happen to be Deutsche Bank, you need to sell, you know, the US dollars to get marks. And that's what's going on now. It is a very, very bad sign. When this happens, it just tells you we are in big, big trouble. So this is not a good sign, not something we're really happy about, but it's leading to foreclosures. And even here in Phoenix, Arizona, we're going to talk about that. It's leading to foreclosures and it's going to cause a banking crisis. So let me go to my next slide here. I'll open it up so you can see this a little better. And let me go to my next slide and we'll just talk about that. You can see this. I mean, this is just verified everywhere you go. You know, we're getting a return on investments are certainly being pressured because rents are coming down. Rents are really softening up. And because they're softening up, your return on investments, remember, these properties are sold. We buy these properties on what we can make as a return. You know, the higher return, more valuable they are. I mean, that's just the way that is. That's just the way it works. If the ROI gets under pressure, it's not as valuable to us. I mean, if I can make $20,000 on this building and 15 on that, I'd rather buy the one for 20,000, right? I mean, this is just simple stuff. So we're seeing that the consumer is being tapped out. They can't afford all the rents. And of course, there's a migration. So all these new buildings that are being built, they're A properties, and there's a migration from A to B, B to C, and that's based on price. So we can see that in the portfolio that we're getting to a lower price. Now, we saw this, we have a timing model, so this really helps us. We instituted a policy of maximizing the tenant, not maximizing the rent. And of course, in our affordable homes, most of our tenants stay put for 5 to 10 years. And we just want to make sure we had really, really good tenants because we saw this coming. But it's going to affect a lot of people. It's going to cause foreclosures because, you know, if you buy an apartment complex or a big tower, these big towers are in trouble based on a cap rate and a return. And if that cap rate and return changes and the value of the property drops, well, people walk away. And the other thing is that as interest rates go up, the cap rate has to go up as well. Because, I mean, if you can get a risk-free asset for 4.5%, why would you take a cap rate of 4.5% and take all kinds of work and all kinds of risk? You just wouldn't do that. You want to get compensated for your risk. And there's no compensation, so people, again, walk away. So this is why we can see it validates our timing model because our timing model is telling us that this should be happening, and it is. So we're assuming that we're going to run into an even worse problem. So I'm warning you guys. And that's why I say foreclosures are coming to Phoenix. As great a market is, you know, my heart goes out to these people. You know, it's not their fault. They did what they thought was right. They're going to lose their houses. They're going to lose their jobs. They're going to lose their cars. Families are going to be impacted. It's not going to be a good thing. But on the flip side of that, we're going to have a clearance sale because the markets need to be cleared. We need to clear all the dead assets out of there and revalue the market. That's where we come in. So fortunes are going to be lost, but fortunes are certainly going to be gained. And that's where we're going to be looking at. So now, if you want to be involved with us and you want to take my time and we sit and talk with us, I've had people say, well, they want to talk with me. Well, I'm very gregarious. I love to talk to people. But the new rules say I have to charge it. So, it's going to cost you $300-400. You know, if it's only a quick conversation, it could be $200. It'll give you the first 15 minutes free. But I do have to charge you. So if you think that I shouldn't be charging you, let me know in your comments and think, well, maybe this should also be a free. If you consult with me for a couple hours, I should do this for free. Maybe, let me know what you think. Let me go to my next slide. Let's just open this up and let's just take a look at that. Oop, wrong one. Don't want that. We want to go here. All right, so this is what I'm talking about here. Is if you see that the property value changes when the cap rate. So we're right now, most of our properties are returning about $18,000 a year at a 4.5 cap. This is certainly changing. It validates the $400,000 purchase price. Now that same building, if it only generates, it just took $100 less a month for rent, is going to drive down the ROI of $16,008. But if we use the same cap rate, it's going to drop $27,000 just based on the loss of rent. But what happens if it loses rent and the cap rate goes up? Well, it severely changes. So this is only a 5% cap rate. That $400,000 building now is $336,000. And holy moly, what happens if we went to 6? We'd be at $280,000. And let's take a worst case scenario and say, instead of $100, we had to give up $200, and we went to a 6% cap. That $400,000 building goes down to $243,000. Do you see where $243,000 might be a problem for someone? You know, do you think that would be a problem? You pay $400,000 and it goes down to $243,000. Is that possible? Yes, absolutely, positively, it is possible. Do you think that would cause some foreclosures? Yes, beyond a shadow of. This is what's happening in the towers, happening in the office buildings, and it's happening with multifamily. Is that exact same scenario is playing out on a much larger scenario. So that's what's going on. So yes, we're at definitely a problem. Let me go to the next slide here. Now, who would ever have thought that this affordability? We're talking about affordability. How terrible was affordability? Look at this. It's affordable. People can't buy their houses. Who would have thought that this would happen? Well, it happened in 2007 exactly the way it's unfolding now, because it came down here. This was 2005 and 6. There was exuberance. Interest rates started going up. And of course, it got to be more and more affordable. Prices were going up. Mortgage payments were going up, and it got down to the point here where it maxed out, where we kept saying it is totally unaffordable. People can no longer afford the houses. The payments went up and the price of the house went up, and this is 2007, and we all know what happens from there. Prices started to cave, and affordability was resolved. So we went down to virtually no one being able to purchase a house because it was so unaffordable to virtually everybody. But prices of homes just collapsed. And that's why up here, affordability was now restored. Now, I think that's going to happen here. I think that's exactly what's going to happen, is that we're going to have affordability is going to get restored in a very, very brutal fashion. Let me go to my next slide and let's just take a look at that. Now, we don't want you to buy and hold these things at the peak. Now, this is what's going on in Miami. Now, I took this out just because it illustrates what's going on. We don't want you to try and catch a falling knife. Let me go over here and let's change over to, let's see if I can get, let's see if we can get this one and see if this comes up. Yeah. Now, I'm going to tell you, this is coming from Zillow. Now, let's just talk a little bit about the difference between Zillow, which is a median prices. Now, these indices are really tricky because the data is only as good as what they're collecting and what they're using. Now, the Case-Shiller is just great. I mean, Dr. Shiller is brilliant. You know, he's a wonderful man. He's really, really smart. But his index is different. Now, when we talk about the indexes I like to use are median. So the median prices means that, you know, it's statistically the middle. Now, when you get an average, you know, these houses in Scottsdale are selling for cash. They're selling for, you know, $2.5–3 million. And you have one of those and you have one that sells in the affordable home range. Well, this house in Scottsdale just drags that index, right? Drags it up. And of course, when you don't have as many affordable homes selling and you have a whole bunch of luxury homes selling, because that's where the market's at, it really skews the averages. Well, it skews the medians as well, but not as much as the averages. Now, let me just talk to you. Let me just go over here and just open this up, and let's go over here and let's just talk about the Case-Shiller, because here's the deal with the Case-Shiller. Let me open this up so you can really see this. So the Case-Shiller is an average, and it's an average of existing homes. So it's a resale value. It's the same homes that have been sold over and over and over again. It's also a moving average. It is a repeat sales management, and it's value weighted, meaning that more value homes giving more weight in the calculations. And it's also non-seasonally adjusted. I like that. But the value weight in a repeat methodology, it doesn't put any condos into the market. It doesn't put any repeat homes, doesn't have any new homes. And if it's in a new areas, which is also where affordable homes are at, they're not counted in this index. So in the last 3 or 4 years, when you start going out to like Surprise and Avondale and Peoria and Goodyear, which are really great suburbs of Phoenix, they're not counted in the Case-Shiller. And this is where the affordable homes are. This is where all the inexpensive buildings were at. This is where the people were just starting out. They always go out to the fringe because that's what they can afford. And that's what's in trouble. So let me go to my slide here and let's just talk about this. So I want you to see this. This is Surprise. Now I know this is Zillow. People malign Zillow. But it's a median. It's a median sales price. So we go here to the median. And if you recall, my timing model peaked in June of 2022. And look at Surprise. Surprise peaked in June of 2022. The median sales price was $495,844. That was the peak. And now it is, this is March. We're just coming into May, so we don't have April. It's 428. So from 495 to 428, that's $70,000. Now I'm going to tell you, we can go all the way back to $70,000. So if you put in, 3%, 5%, so 5%, you put $25,000 in as your down payment, and you are underwater $70,000, you're in trouble, pal. This is not something that's good for you. And we have to go all the way back. This is to right here. And I'm thinking that once we get March or in April, they're going to be even lower than that. So all the way back to October of 2021, just to break even. And of course, this is not going to cost the sales. So I want to tell you, we sold thousands of homes in these areas since in the last 3 years. We sold thousands of them. All of these guys, if you bought after really October, fourth quarter of 21, you're underwater, and you probably have to go all the way back down here to beginning second quarter of 2021 just to get out because there's cost of sales. None of this stuff is cheap. So all these people, and I'm telling you, thousands in Surprise is a really good market. I love Surprise. We have a big presence in. We have a big presence in Surprise. I love Surprise. Surprise is just absolutely outstanding. Surprise is 10, 15 minutes to the Taiwan Semiconductor, and the whole area is just exploding. Everybody wants to be there. It's 10 minutes to Luke Air Force Base, which is the air wing for the F-35s. Billions of dollars coming in. Absolutely phenomenal. I want to buy more. It's just overpriced. It's overpriced like Florida. It's overpriced like Texas. These are great, great markets. They're just ahead of themselves. And if you would have bought in any of these developments at that time, you'd be losing money. Now, this is the beauty of my timing model, is the fact that it forecasts what's going to happen. I saw the fact that on my model in real time, this is really hard. I'm going to pat myself on the back on that because I did see it in real time, that I thought we peaked. And we did a 90-day moratorium. I said, we're going to stop putting capital in. And in 90 days, we'll reevaluate. Well, we're still on that moratorium. We haven't bought anything since June of 2022. And I've been validated since then. And so we don't want to buy anymore. But we've been sitting on the sidelines with lots and lots and lots of cash. And we're going to be buying a ton of this all through Surprise. It's just an absolutely outstanding property. You know, we have so many people leaving California and leaving from Silicon Valley, for one. You know, we're just as smart here in Phoenix as we are in Silicon Valley, except that the cost of doing business is about 30%, maybe 25%. And you can get the same startup done here in the East Valley that you can in Silicon Valley, you know, for like 25% of what you're paying. We have people leaving and coming here. And of course, we're a business-friendly state. Do you know we did so well on our taxes that the state government actually reduced our state income tax by 2.5%, and he did it a year early. Our property taxes are dirt cheap. You know, I've got a condo in Scottsdale. My taxes are $200. You know, the average real estate tax in Surprise is about $1,600 to $1,800 a year. Great place to do business. So you can see where we want to get into this. Let me go to my next slide here, and let's see if we can't get back in here. So we know that somewhere along the line, not this way we want to go. Where do we want to go here? I go there. We know somewhere along the line something is going to break. Always does. Something always breaks. Surprises, we're going to start buying like crazy in Surprise. Now, if you want to reach me, this is where I'm at. We're going to do this soon. You're going to have an opportunity to buy these properties soon. So I would say you probably want to get to know me. I want to get to know you. You know, consultation with us, it's an hour and a half, 2 hours, could go 2.5 hours. I've had people say, well, we've got properties in Chicago. And I say, well, why? Why do you have it in Chicago? What's your 5-year outlook in Chicago? You know, it's terrible. What's your 5-year outlook like in Minneapolis? It's terrible. You know, it's pretty doggone amazing here in Phoenix, Arizona. So, I mean, your opportunities are here. So if you've got buildings that are around the country, it's just going to take us some more time for us to do a plan and try and figure out how we're going to get you out of there. And we want to expedite this and make sure we do it in a smart way. So this is not, we're going to sell. We don't just sell. We sell if we've got a better deal. So, and we make plans. We want to make sure, and I don't know what a better deal is for you without talking to you and spending some time. So we do want to get hold of you, and we want to make sure that I'm a good fit for you and you're a good fit for me. It's going to cost you a couple bucks. You know, I'm sorry, guys. You know, it's just, you know, I've been in business for 50 years. I've made millions of dollars for people. If you think that what I'm giving you is baloney, then we will part our ways and I won't charge you. But typically we do. And, you know, if you do business with us, we'll give you half back. So it's not so bad. And we've got a full staff. You know, we're certified real estate investment advisors. Have a full staff of them. They know exactly, you know, they knew how to do a cap rate. They knew how to do depreciation. You know, we've got buy boxes and growth corridors and buy protocols. So we've done this really, really well. And we have a ton of property managers. That's all they are property managers. They're not like, oh yeah, I'm going to property manage, but I'm also going to do something else. They don't. That's all they do. They've been vetted by me. You can do it yourself. You can do absolutely everything that you own. You will own these properties, not me. But most people find out that these are business expenses. You know, we use flat rate too, by the way. They're not business with you. And they charge you, you know, from $80 to $120 a month to handle your properties by the door. You know, so whether you get $500 a month or you get $5,000 a month, it's the same fee. So we use a lot of those, and they'll take you by hand. You know, so you can buy one of our properties and within 30 days start getting checks. We'll get a tenant right in, get it all taken care of. We'll do the whole thing for you, or not. Your choice. So listen, I'd love to get your business. I need to know soon because I think business is coming soon. We need to start getting together and start making plans. We got to talk financing. We got to talk, you know, what's good for you. If you need to finance, and I'm going to suggest that even if you can pay cash, that you just put a scotch of financing on. We just want to put a little bit of leverage onto it, so you know, let the tenant pay it off for you. So give me a call, and let's set something up. My very best to you guys. Bye-bye now.